The American housing dream is under pressure like never before. From soaring mortgage rates to rising insurance costs, once booming cities are starting to crack under the weight of prices that don't make sense anymore. Families are squeezed, buyers are retreating, and entire markets are shifting from growth to decline. In this video, we'll look at 10 US cities where the housing market is heading for serious trouble. And make sure you stick around until the end, because the final city on this list isn't just vulnerable, it's already unraveling, with numbers that point to a full-scale collapse. Subscribe now, because staying ahead of these shifts could save you from making one of the most expensive mistakes of your life. Number 10. San Antonio, Texas. San Antonio is famous for its rich history, cultural diversity, and reputation for affordability. At least that's how it used to be known. Over the last decade, and especially during the pandemic, the city became a magnet for families priced out of Austin, just 80 miles away. From 2020 to 2022, San Antonio home values surged by more than 40%, one of the steepest increases of any Texas metro. But that affordability advantage has all but vanished. The median home price now sits just above $300,000, while the median household income is only $58,000. At current mortgage rates, monthly payments consume nearly 40% of the average family's income, well above the 30% threshold considered sustainable. For many households, the dream of ownership has become financially impossible. Market dynamics are worsening. In 2021, homes sold in just 25 days on average. Today, they linger for nearly 65 days, reflecting a sharp drop in demand. Active listings have climbed almost 30% year over year, flooding the market with unsold homes and pressuring sellers to cut prices. The distress is already visible in foreclosure data. According to Adam, filings are up 22% in the metro, as families who bought during the peak now face mortgage payments they can't keep up with. Unlike Austin, with its tech-driven salaries, San Antonio's economy leans heavily on tourism, healthcare, and the military. These industries provide stability, but they don't deliver the wage growth needed to sustain runaway housing prices. Another red flag is rental strain. Average rents have risen above $1,400 per month, leaving more than half of renters officially cost burden. That's creating a squeeze from both sides. Owning is unaffordable, and renting isn't much better. San Antonio's vulnerability lies in its growth narrative. Buyers poured in, chasing the idea of affordable Texas housing, but demand drove prices beyond what local wages could support. Now, the city finds itself trapped between high housing costs and stagnant incomes. A correction isn't just likely, it's already happening, and the pace may accelerate if rates stay elevated. Number 9. Cape Coral, Florida. Cape Coral is often called the waterfront wonderland, with more than 400 miles of navigable canals, more than Venice itself. That promise of waterfront living drove a surge of retirees and second home buyers into the market. Between 2020 and 2022, home prices here skyrocketed nearly 60%, one of the sharpest increases in Florida. But Cape Coral's dream is colliding with harsh reality. Insurance premiums in Florida have spiraled out of control. The average homeowner in Cape Coral now pays over $6,000 a year for coverage, more than 3 times the national average. For retirees on fixed incomes, that wipes out any sense of affordability. The market has responded quickly. Inventory has doubled since 2022, with more than 35% of listings cutting prices in the past quarter. The average time on market has jumped to 75 days, compared to just 25 days during the pandemic boom. Hurricanes make matters worse. When Hurricane Ian hit in 2022, thousands of Cape Coral homes were damaged. Recovery costs pushed many homeowners into financial stress, while buyers grew wary of taking on properties that might be uninsurable in the future. Bama maps show that nearly 70% of the city's housing stock is in areas classified as high risk for flooding or storm surge. The affordability issue is brutal. Median home prices in Cape Coral hover around $380,000, while the median household income is only $62,000. That mismatch means locals can't buy, leaving the market heavily dependent on out-of-state retirees and investors. If that inflow slows, whether because of insurance costs, climate fears, or higher rates, the market collapses under its own weight. Cape Coral is beautiful, but beauty doesn't pay the bills. For many, the waterfront wonderland is turning into a financial nightmare. Number 8. Los Angeles, California. Los Angeles has always been expensive, but right now it's approaching unsustainable. The median home price in LA sits around $900,000, while the median household income is just $74,000. That's a 12-to-1 price-to-income ratio, one of the worst in the entire country. At current mortgage rates, monthly payments on an average LA home top $6,000 before taxes and insurance. That's simply impossible for the vast majority of residents. The result? Demand is collapsing. Home sales in LA are down nearly 25% year over year, while inventory has jumped by more than 30%. Price cuts are becoming routine, especially in the luxury segment where international demand has cooled. New taxes targeting high-end sales are pushing wealthy buyers elsewhere, leaving multi-million-dollar homes languishing on the market. Foreclosures are beginning to rise, particularly in lower-income neighborhoods where pandemic-era buyers stretched thin to get into the market. Rental affordability is also collapsing. Average rents now exceed $2,900 per month, with nearly 60% of renters officially cost-burdened. What's striking is the shift in psychology. For decades, Los Angeles defied the math. Prices were high, but demand was endless. Now buyers are waiting, convinced that prices have peaked. That shift alone can drag a market down, because once confidence breaks, sales freeze. The last time LA saw this mix of high costs and weakening demand was before the 2008 crash. Back then, prices fell more than 30% in just 3 years. While today's conditions aren't identical, the warning signs are clear. For all its glamour, Los Angeles is stretched to its breaking point. Unless incomes triple overnight or mortgage rates collapse, the market simply doesn't work. Number 7, El Paso, Texas. El Paso has often flown under the radar compared to flashier Texas markets like Austin or Dallas, but in recent years it became one of the state's unexpected housing hotspots. Prices surged by more than 35% between 2020 and 2022, fueled by demand from buyers escaping higher-cost metros. But the problem is clear: wages in El Paso simply don't match the prices. The median household income is just $51,000, one of the lowest among major Texas metros. Compare that with the current median home price of around $250,000 to $260,000, and you see the affordability squeeze. At 7% mortgage rates, monthly payments eat up more than 35% of income for the average family. Right on the edge of being considered severely cost-burdened, El Paso's economy is stable but limited, anchored by Fort Bliss, one of the largest U.S. Army bases. Along with healthcare and cross-border trade, jobs here tend to be steady but low-paying. There isn't the high-income sector to prop up prices like Austin's tech or Houston's energy jobs. In fact, more than 30% of households earn less than $35,000 a year, which makes homeownership nearly impossible at today's prices. The inventory picture is shifting too. Active listings are up nearly 28% year over year, and homes are staying on the market longer. The average time to sell is now about 60 days, double what it was during the pandemic boom. New construction hasn't slowed either. Builders are still delivering homes, which risks adding even more supply into a cooling market. The foreclosure rate is rising as well. Adam reports filings up 19% in El Paso County, concentrated in neighborhoods where buyers stretched thin with FHA loans and little down payment. Rental markets aren't much better. Average rents have climbed to $1,200 per month, leaving more than half of renters officially cost-burdened. El Paso may not face the sharp collapse of pricier metros, but its problem is just as dangerous. Stagnation. When incomes don't grow, but costs keep rising, families get squeezed, sales dry up, and values drift downward. For a city used to stability, that slow erosion may feel like quicksand, subtle but relentless. Number 6, Scottsdale, Arizona. Scottsdale has long been promoted as a desert paradise, a place where golf courses stretch for miles, high-end shopping draws wealthy visitors, and the sun shines almost every day of the year. It's often branded as the Beverly Hills of the Southwest, but behind the glamour and lifestyle marketing, the city's housing market is starting to reveal cracks that can't be ignored. Home prices here are among the highest in Arizona. The typical property now costs more than $750,000, a figure that makes Scottsdale one of the least affordable housing markets in the entire state. On paper, the median household income of about $105,000 looks impressive compared to national averages. Yet at current mortgage rates, the average monthly payment exceeds $4,800, and that's before property taxes, HOA fees, or insurance. For even upper middle class families, those numbers are difficult to sustain. Scottsdale's pandemic boom supercharged this problem. Between 2020 and 2022, the city became a magnet for out-of-state buyers, especially Californians seeking sunny weather and lower taxes. Demand exploded and prices jumped nearly 40% in just 2 years, but the migration pipeline has slowed dramatically since 2023. Today, inventory has surged by more than 35% year over year, and homes that once sold within days now sit unsold for months. Almost 40% of listings have cut prices in the last quarter alone. Tourism has always been a major driver of the local economy. Seasonal events, golf tournaments, and the hospitality industry provide jobs and income, but they also make the market more vulnerable to downturns. When visitor numbers dip, so does the appetite for vacation properties and investment homes. The short-term rental boom added fuel during the pandemic, but now it's backfiring. Airbnb saturation has driven nightly rates down, and short-term rental income has fallen nearly 20% since 2022, leaving investors struggling to cover their costs. The deeper issue is that Scottsdale is a luxury market dependent on endless demand. Once confidence slips, momentum reverses quickly. We saw this in 2008 when Scottsdale home values collapsed by nearly 35% in just 2 years. The conditions today, sky-high prices, heavy speculation, and slowing demand, look eerily familiar. Scottsdale still appears glamorous on the surface, but the fundamentals tell a different story. Beneath the golf courses and designer storefronts, the math simply doesn't work, and broken math doesn't keep million-dollar homes afloat for long. Number 5. Salt Lake City, Utah. Few U.S. cities saw a housing boom as dramatic as Salt Lake City's during the pandemic. Between 2019 and 2022, home prices soared by more than 50%, fueled by rapid population growth, heavy investor activity, and the city's rising profile as a tech hub known as the Silicon Slopes. But the aftermath has been just as striking. Salt Lake is now ranked among the least affordable housing markets in America. The median home price hovers around $530,000, while the median household income is only $80,000. That translates into a 6.6 to 1 price to income ratio, well above the healthy 3 to 1 benchmark. At today's interest rates, a typical mortgage requires payments of more than $3,800 per month, a crushing burden for most families. The affordability crisis has frozen demand. Home sales are down nearly 30% year over year, and properties that once sparked bidding wars now linger on the market for about 70 days. Inventory is swelling, especially in new subdivisions where builders assumed demand would never slow. In some developments, entire streets of brand new homes sit half empty, echoing the overbuilding patterns seen before 2008. Investor speculation magnified the problem. Out-of-state buyers poured into Salt Lake, scooping up rentals and flips, but rents haven't kept up. Average monthly rent is around $1,700, far too low to justify purchase prices above $500,000. That imbalance is forcing many investors to sell, adding more supply and further pressuring prices. Even the tech sector, the city's growth engine, is showing cracks. Once hailed as the next Silicon Valley, hiring has slowed and several high-profile firms have announced layoffs. Without steady in-migration and high-paying jobs, Salt Lake loses the foundation that propped up its meteoric rise. Salt Lake remains beautiful, framed by snow-capped mountains and boasting a strong cultural appeal. But as history shows, beauty doesn't balance budgets. The city experienced a steep correction after the 2008 crash, with home values dropping over 25% in 3 years. Today's setup, soaring prices, investor speculation, and slowing job growth suggests a similar downturn may be approaching. Salt Lake City may still look like a dream destination, but beneath the surface, the math is unforgiving. Affordability is shattered, momentum is slipping, and a sharp correction may be just around the corner. Number 4. San Diego, California. San Diego has always had the reputation of being California's paradise. With near-perfect weather, beautiful beaches, and a thriving biotech and defense industry, it has consistently been one of the most desirable places to live. But lately, that paradise comes with a serious price tag, and cracks are starting to show in the housing market. The median home price in San Diego County is hovering around $850,000, more than 10 times the median household income of $82,000. That's a ratio that economists label severely unaffordable. With mortgage rates sitting at 7% 30%, a buyer looking at an average home would face monthly payments of nearly $5,600 before taxes and insurance. Even for dual-income households, that math simply doesn't work. The affordability problem has frozen the market. Sales volume has dropped by 33% year over year, one of the steepest declines in California. Homes that once sold in bidding wars within days now linger on the market for 65 to 75 days. Active listings have surged nearly 40% since 2022, creating the first real buyer's market the city has seen in years. Rental prices tell a similar story. Average rents now sit at $3,000 per month, leaving over 60% of renters cost-burdened. With rising interest rates, many would-be buyers are stuck renting, but they aren't saving much money by doing so. San Diego's economy is strong on paper. The biotech sector is thriving. Military bases provide stability, and tourism keeps the city busy. But none of those sectors are generating the kind of wage growth needed to sustain these prices. In fact, wages have grown just 3% annually since 2019, while housing costs have surged by over 40% in the same period. That imbalance is pushing families out, with thousands relocating to cheaper parts of inland California or even out of state. San Diego's problem is structural: limited land, high demand, and a regulatory environment that slows new construction. That kept prices high during the boom, but now it's amplifying the pain as affordability collapses. The last time San Diego saw this kind of mismatch, before the 2008 crash, home prices fell by 35% in just 3 years. Today's setup feels uncomfortably similar. Number 3. Las Vegas, Nevada. Few cities embody boom and bust cycles like Las Vegas. From the glitz of the Strip to sprawling suburban developments, the city's fortunes rise and fall with the economy, and its housing market is once again flashing red lights. During the pandemic, Las Vegas became one of America's hottest destinations. Californians fled high costs and taxes, driving Vegas home prices up nearly 50% between 2019 and 2022. At the peak, the median home price reached $450,000, an all-time record for the city. But reality is setting in. As of late 2024, prices have slipped back to around $420,000, and the decline is accelerating. Active listings are up 60% compared to 2022, the highest jump of any major metro in the West. Homes that once sold in bidding wars now sit on the market for 80 days or more, a complete reversal from the 15-day frenzies of just 2 years ago. The affordability math is brutal. The median household income in Las Vegas is about $66,000. At today's mortgage rates, buying the median home requires spending nearly 50% of monthly income on housing. Well beyond sustainable levels, renters aren't doing much better. Average rents are around $1,800 per month, but vacancy rates are rising as affordability pressures push tenants to double up or leave. Las Vegas's economy adds another layer of risk. Nearly 25% of jobs are tied to hospitality, tourism, and entertainment, industries notoriously vulnerable to downturns. A dip in tourism, whether from higher travel costs, economic slowdown, or global shocks, hits Las Vegas harder than almost anywhere else. That vulnerability was on full display during the 2008 crash, when Vegas home prices fell more than 60%, one of the steepest collapses in the nation. Investors are also pulling back. Las Vegas was one of the biggest Airbnb hotspots in the US, but oversupply and stricter regulations have cut into profitability. Thousands of short-term rentals are now being converted back into long-term housing, swelling inventory and depressing prices further. For Las Vegas, the issue isn't just high prices, it's volatility. The city's housing market behaves more like a casino than a stable asset, and right now, the odds are stacked against homeowners. Number 2. Phoenix, Arizona. Phoenix was the poster child of the pandemic housing boom, and it may also become the poster child of the bust. Between 2019 and 2022, Phoenix home prices soared by nearly 70%, one of the largest increases of any US metro. The frenzy was fueled by Californians moving east, institutional investors buying thousands of homes, and low interest rates that made mortgages cheap. But the tide has turned. The median home price in Phoenix now sits around $430,000, while the median household income is just $75,000. That's a 5.7 to 1 price to income ratio, far above the healthy level of 3 to 1. At today's interest rates, the typical mortgage payment eats up nearly 45% of household income, leaving little room for anything else. Inventory tells the story. Active listings have tripled since mid-2022, climbing above 20,000 homes on the market. Builders who once raced to keep up with demand are now sitting on unsold developments. Entire subdivisions subdivisions stand half empty, echoing the ghosts of 2008. Foreclosures are creeping up as well. Phoenix saw a 27% rise in filings year over year, the sharpest increase in Arizona. Many of these are tied to buyers who used adjustable rate mortgages during the boom, and now face payments hundreds of dollars higher each month. The rental market isn't offering relief either. Phoenix rents climbed nearly 40% from 2019 to 2022, and while growth has slowed, average rents remain around $1,800 per month. Vacancy rates are climbing, and landlords are offering concessions just to keep tenants. Phoenix's vulnerability lies in its dependence on constant growth. The city has long been one of the fastest growing metros in the US, but that growth is slowing. Net migration into Arizona dropped by 20% in 2023 as affordability collapsed and Californians reconsidered their options. Without that influx of new residents, demand shrinks fast. Phoenix was ground zero in the 2008 housing collapse, losing nearly 56% of home values in 4 years. The setup today, rapid run-up, investor speculation, oversupply, feels hauntingly familiar, and if history repeats itself, Phoenix could be facing another painful correction. At the top of our list is Buckeye, a suburb of Phoenix that became the poster child for America's suburban sprawl. Just 20 years ago, Buckeye was a sleepy farming town with fewer than 7,000 residents. Today, it has exploded to nearly 115,000 people, making it one of the fastest growing cities in the United States. But that explosive growth has come at a price. Median home prices in Buckeye now sit at about $400,000, up nearly 65% since 2019. That might sound like a deal compared to Scottsdale or Los Angeles, but here's the problem. The median household income in Buckeye is only $76,000. At current mortgage rates, monthly payments swallow almost half the average family's income. The rapid expansion has also created oversupply. Entire subdivisions were built during the pandemic boom, banking on endless migration from California. But now, active listings in Buckeye are up more than 80% year over year, and many new homes sit unsold. Builders are offering steep incentives, covering closing costs, slashing prices, even throwing in upgrades, just to keep sales moving. Foreclosure risk is rising too. Many families bought with FHA loans or small down payments, assuming prices would keep climbing. With values flattening or even declining, those homeowners are already underwater. Atom data shows foreclosure filings in Buckeye up 35% year over year, one of the sharpest spikes in Arizona. Infrastructure hasn't kept pace with growth either. Schools are overcrowded, commutes into Phoenix can stretch over an hour, and water scarcity looms as a major long-term threat. The very features that made Buckeye attractive, cheap land and rapid development, are now its greatest vulnerabilities. What makes Buckeye the riskiest market is the combination of explosive growth, heavy investor activity, and fragile fundamentals. It mirrors the worst excesses of the 2008 bubble, when Buckeye was one of the hardest hit cities in the entire country, losing more than 60% of its home values. Today, history looks like it's ready to repeat itself. The housing market is shifting fast, and these cities show where the cracks are deepest. Cheap money, speculation, and overgrowth fueled a bubble that can't last. Stay ahead of the crash. Subscribe now, because the next housing collapse won't wait for anyone.